The Bank of Canada continued to raise interest rates last month by 1/4 point, signaling that they might be ending the interest rate increases. However, they walked back the notion of any idea that they were pausing really fast. And that's probably not what you saw in the media because they had published their articles well before Tiff Macklem could create any sort of clarification. But at the same time that interest rates were going up, fixed rates continued to stay steady or go down in some cases. And that's making a fixed rate a really compelling idea right now for both people who are new to the market and for those who already have a variable rate mortgage. And at the end of this video, I'm going to show you a 3-year rate that could create a really great strategy for both people who are buying new homes and people who already have existing variable rate mortgages. But you're going to have to stay till the end of the video to see that. But before we get into all the juicy rate details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that like button and hit that subscribe button so more people like you can see this video. And don't forget, I'm giving away my new book, Mortgage Secrets, at mortgagesecrets.ca. Now, I need to make a really clear point here because it's been brought up in the comments. There's been some people who've questioned my character and questioned whether or not this was really a free book giveaway. And if it was really a free book giveaway, why don't I just give away a PDF so people don't have to pay the shipping and handling? By the way you get the book for free is you go and you pay the shipping and handling. It's super cheap and it is far cheaper than what you would have to pay for the book by itself. But I want to make this clear. The reason why I'm giving away the first 1,000 copies of this book is because this is going to be my only opportunity to do that. As an author, it is both an honor and a privilege to be able to take a physical book and sell it in real bookstores. And this book will go on Amazon sometime this month. But here's the thing, if I were to put it on Amazon, I can't give it away for free because Amazon has a very strict policy that your book can't be sold somewhere else for a cheaper price than what it's available for at Amazon. And the reason I wanted to give it away for free is because there's a whole bunch of people on this channel who have supported me for a very long time. And there's a whole bunch of new people who are showing up who are going to be getting into the market for a mortgage. And I just wanted to give the people who showed up and watched my videos the opportunity to get this before it hit the public market. So the free book thing, it's legitimate. It's not a gimmick. I'm genuinely giving this away for free. All I'm doing with the shipping and handling is making sure that the cost to ship it is covered by you and not by me. The shipping and handling is a straight flow-through cost, and everything else with respect to this book is absolutely free. So it's my gift to you. It's my thank you to you. And no, it's not a gimmick. It's not a scam. It is legitimately, this is the only time I will be able to do it because of the policies that come along with publishing a book and putting it into real bookstores. This isn't just some document that was created in a week. This took over 1.5 years to create and make sure that we got it exactly right. So I hope sincerely that you're able to grab one of the last free copies. And if not, it will be available on Amazon for you to buy and also will continue to be available on mortgagesecrets.ca, albeit for a significantly higher price. Okay, so let's get back to the task at hand. Sorry for that aside. Let's get back to interest rates and where we're at in February of 2023. This was an interesting month this last month with respect to interest rates. Obviously, we saw variable rates go up by 1/4 point, but we saw fixed rates come down slightly in some categories, which was interesting. And we started to see more and more 3-year fixed specials, which are going to become hugely important here in the next couple of months as people both get into the market and also maybe transition if they aren't loving the idea of having a variable rate mortgage anymore into fixed rates. And there is some opportunities here, which I will explain later on in the video. But without further ado, I want to jump you in and show you the interest rates. And as we always do, we're going to start with 5-year fixed full feature mortgages. Now, full feature mortgages are the mortgages that have all the best prepayment privileges, the ability to pay out the mortgages and go to a different lender if interest rates go down, and generally are just the mortgages that may cost you slightly more, however, could save you tens of thousands of dollars if the right opportunities come up within the 5-year term. And with interest rates expected to go down sometime at the end of 2023 or in early 2024, depending on the economist that you're talking to or the economist that you're reviewing in the news, having the opportunity to get a lower interest rate is going to be hugely important in the future. So you want to make sure you have a full featured mortgage. I'll get into what a discounted mortgage is a little bit later on, but if you really want to deep dive into what the differences are, the Mortgage Secrets book is the place to find that. Okay, so 5-year fixed insured mortgages, these are the safest mortgages for the banks and the lenders. These are subsequently priced the lowest, and they are starting right now at 4.89%, which is a really good rate considering that these got substantially higher at the end of 2022. And then getting into 20% down, These are the riskiest mortgages for the lenders because this is where the lenders don't have insurance and therefore have the highest exposure for risk for the banks. Now, this used to be where you start to get a better rate. In today's day and age, this is where you start to pay more because you don't have to pay that CMHC premium, but you need to pay the lenders for the higher risk of these mortgages. And they have algorithms and they have data and they have all sorts of math that supports that these rates are the right rates based on the risk profiles. So at 20% down, you're looking at 5.19%. Now, once you get to 25% down, you get to 5.09. So you can see as the down payment goes up, the interest rates get slightly better. At 30% down, you don't get a big bump in interest rates, but then when you get back to 35% down, so more than 35% down, you start to get to the 4.89% range again. Now, for mortgages that are over $1 million, for any time you're doing a refinance, for any time you're getting an amortization that is longer than 30 years, you have what's called an uninsurable mortgage. The 20 to 35% categories have what's called back insurance on them typically. However, mortgages that are over $1 million or over 25-year amortization or that are refinances are uninsurable. So if you're getting that type of mortgage, you're looking at 5.24% on a 5-year fixed full featured mortgage. Now, moving into the variable rates, we haven't seen much movement here other than the 0.25% Bank of Canada increase that increased prime from 6.45 to 6.7%. We haven't seen too many changes in the discounts here. So as of today, if you are looking at a 5-year variable that is insured, you're looking at basically 5.8%. Once you start getting to 20% down, again, a lot more risk here, especially with variable rate mortgages. You can see that in the pricing. You're at prime minus 0.55%. So what you would do is you'd take 6.7 and subtract 0.55 from it, and that would give you your 6.15%. That's the base rate. And then when you start to get 25% down, you can see they're still pricing in a lot of risk at the 25% down number. And then once you get to 30% on a variable rate mortgage, they're starting to see a little less risk there. And as a result, you're at prime minus 0.75. So that gets you into that 5.95% range. Then at greater than 35% down, you start getting back into that prime minus 0.9 again, which is that 5.8% rate. Now, on mortgages that are uninsurable, mortgages that are refinances, mortgages that are over $1 million, and mortgages that are greater than 25-year AMs, you're at prime minus 0.4, so 6.3%. Believe it or not, this is an improvement over January when you could only get prime minus 0.2%. So therefore, the discount has actually gotten better on these mortgages. Now, moving into 5-year fixed discount mortgages. So what a discount mortgage is, to be clear, these are mortgages that have certain features stripped away or they have certain clauses, like what's called a bona fide sale clause, which means you can't go to a different lender within the term. Even if you pay the penalty, you can't pay the mortgage out. You have to hold on to the mortgage. There's all sorts of things that lenders can do to make a mortgage, in theory, mathematically more profitable. And discount mortgages tend to have these types of things built in order to get the rate lower. And what you'll see is that these rates are typically about 0.2 to 0.3% cheaper, which depending on the size of your mortgage can be about a cup of coffee a week for you and your spouse. So it's not a significant difference, but it can prevent you from getting a lower interest rate down the road, which means you could end up spending tens of thousands of dollars more because you don't have options and therefore end up paying a higher rate if interest rates go down. So 5-year discounted mortgages starting at 4.59%, again, appears to be a good interest rate compared to the full featured. But hey, if interest rates go down to below 4% again, which some economists and some people are predicting will happen, then you don't have the option of getting into the lower rate mortgages. And by the way, the people in 2020, March of 2020, when interest rates dropped from 3 or 4% down to 1.5%, the people who couldn't get that 1.5% rate were people who had big bank mortgages and people who had discount mortgages that had bona fide sale clauses and the inability to switch to a different lender. So it's important that you know the difference here. Again, it's all in the Mortgage Secrets book, and I've covered it on a bunch of videos on this channel. Make sure you know the difference and make sure that you know the type of mortgage that you're getting into. The two enemies of the Canadian consumer right now with respect to mortgages, and quite frankly, for the last 5 to 10 years, are the big banks on a 5-year fixed mortgage and discount mortgage companies who are putting people in mortgages and not explaining all the drawbacks of those mortgages in the long term. So when you start getting into 20% down, you're looking at 4.89%. When you start getting to 25% down, 4.79%. You'll see that rate is the same at 30% down. When you get to greater than 35% down, you're back in that 4.59% range. And then uninsurable refinances over $1 million, greater than 25-year amortizations is priced at 5.24. Now, for 5-year variable rate mortgages, these are discount mortgages. I've rarely seen anybody take a variable rate discount mortgage because there's so many drawbacks to them when you think about the benefits of a variable rate and being able to get out of it with a 3-month interest penalty. Well, not having those options doesn't make a ton of sense, but here they are nonetheless. You're looking at prime minus 1.15, so basically 5.55%. If you're getting into 20% down, you're looking at prime minus 0.8. So that's getting into the 5.9% range. And again, you can start to see how they're pricing these based on risk. At 30% down, you're looking at 5.7%. And at greater than 35% down, you're back into that 5.55% range again. Now, for uninsurable refinances over $1 million, greater than 25-year amortizations, you're looking at prime minus 0.2. Now, at the beginning of this video, I promised you that there was a 3-year strategy that makes a ton of sense. And let me just go through that strategy with you real quick, because here's the deal. The science and the math behind picking a fixed versus variable rate mortgage has remained the same. And the recommendations that we made in 2020 and 2021 and the perspective we provided on variable versus fixed rate mortgages still remains the same. And that has always been that if you can get a variable rate mortgage for significantly cheaper than a fixed rate mortgage, then it makes sense to choose a variable rate mortgage from an odds perspective, from a math perspective. Now, obviously that was proven wrong because we did not expect interest rates to go up as fast as they did. The Bank of Canada did not expect interest rates to go up as fast as they did. Tiff Macklem sat there and said, we're going to have low rates for a very long time. And while some people claim that they saw these high interest rates coming, the reality is that most people didn't see them coming, including a lot of the experts. But that doesn't change the advice that we give now. And that is when you can get a fixed rate mortgage for significantly less than a variable rate mortgage, it might make sense to look at those options. So as of right now, you can get 3-year mortgages for about 1% less than you can get a 5-year variable. And what that means is that for a lot of people who have variable rate mortgages or who are getting into the market, the 3 years is making a lot of sense, because if interest rates do come down, like a lot of people believe that they will, this still gives you a 3-year runway in order to have a significantly lower interest rate. And if interest rates go down below the 3-year rate, well, you always have the option of paying the penalty if you've chosen the right lender and getting into a lower rate variable rate mortgage down the road. So let me show you what these 3-year rates are. These are what we're recommending to a lot of our clients right now, because these are the highly beneficial rates that make the most sense. So if you look at a 3-year fixed rate right now, these are full featured mortgages. You want to make sure that you've got the ability to switch to a different lender, get a lower interest rate, all those things. If interest rates do come down significantly faster than what we think they will, well, you want to be able to get back into the variable or get back into those lower rate mortgages. So make sure you have a full featured mortgage here. You don't know what those are? Call us, check out the book, look at the other videos I've made on this channel about that, because it's hugely important. It is the single most important factor when it comes to your mortgage. For an insured 3-year fixed, you're looking at 4.89%. Now, this is about the same rate as a 5-year fixed. However, if you believe that interest rates are going to come down in the next year or two and you're a variable strategy type borrower, this gives you some short-term bandwidth to know that your payments aren't going to go up. It's significantly lower than a variable rate, and it allows you to save some pretty significant money. So on a $500,000 mortgage, 1% difference in the interest rate saves you about $5,000 a year. So it makes a ton of sense. When you're looking at greater than 35% down, you're also looking at that 4.89% rate. Now, when you get into the uninsurable mortgages, you're looking at 5.09. But these compared to the variable rates that you may already be paying or the variable rates that you may be looking at are a really good option. Of course, if you want to borrow on the 5-year fixed and get that extra 2 years of guarantee of the 4.89 rate, that's up to you and your risk tolerance. It totally makes sense. But if you are the type of person who would normally choose a variable rate, the 3-year fixed option seems to be the right option for now, because it gives you that 3-year runway where you are able to know exactly what your rate's going to be and that you've got about 4 interest rate drops before you get into that rate territory. Now, if you want to check out the video I did most recently on the Bank of Canada update and the forward-looking risks that could affect the economy, which could have interest rates going both up and back down, make sure you check it out here. I'm going to link to it. It's a really important video, especially when you're making these fixed versus variable decisions. So make sure that you understand the risks of both choosing that fixed and that variable. Your risk tolerance is the primary factor when it comes to determining which mortgage you should be choosing, not timing the market as some people would have you believe. It's not about trying to pick a variable at the right time or a fixed rate at the right time, but knowing what type of borrower you are and knowing that you're making the right decision for you. So again, I'll link to it right here.